So good morning, everyone, and welcome to another Tech Tribe Community Masterclass. My name is Tarisiro Matiza, and I will be your host this morning. In the last month, we've been on this journey with the Moolman Institute to better understand the financial aspects of our business. And it's something that we've always handed off to the accountant. But as a founder and an entrepreneur, it's really important for ourselves and for us to understand all of those different metrics. And last month, we covered we understood the two different metrics to help us evaluate our businesses. And that was net present value and the internal rate of return. So this morning, Sean is joining us again to help us understand the three big financial statements: the income statement, the balance sheet, and of course, the cash flow statement. And who is Sean? Sean is the founder of the Moolman Institute, an online learning institute focused on technology commercialization and innovation. He is also the co-founder of Power Optimal, an energy technology company, director of several companies, and previous head of technology transfer at the CSIR. He also has a PhD in chemical engineering and completed a management advancement program at the Wits Business School and is a registered technology transfer professional. So Sean knows what he is talking about. He's got the experience. And he's back again this morning to share to teach us and to help us learn more about our financials for our business. I'll hand over to Sean. I see just a few more introductions. We've got Div joining us from Pretoria, and he is an SME mentor. So welcome, Div. We've also got Matilda from Botswana, Silas from Kenya. So we've got the Southern Africa in with us, joining us this morning. So that's very exciting. I won't take any more of your time, Sean. I'll hand over to you and let's get learning. Thank you.
Yeah, thanks very much, Tari. And thanks again to the Tech Tribe community for arranging these events. I think it's, it's a valuable service that you're providing to the startup and small business community. So very excited to present, to have the opportunity to present this second masterclass. For those of you that also attended the first one, welcome back. For the ones that haven't, I hope this one will be useful, will prove to be useful to you. And also, you can find a recording of the first masterclass on the SA Innovation Summit website under the community tab. So today is as I said, the second masterclass, and we're going to be focusing on understanding and analyzing financial statements. So as Tari said, as an entrepreneur, as a small business owner or CEO, the financials are really the scorecard of the success or not of your business. That's the way that you understand what's happening within your business. That's the way that you keep score and that you understand whether you're improving things or not. So it's something that you cannot avoid having to understand and to know about. And as Tari also said, you can have the accountants do the books for you, but you really need to understand what those books tell you in the end. So hopefully today's masterclass will make a small contribution towards improving your understanding of your own financial statements and those of other businesses, and also help you understand how to analyze these financial statements. So what we're going to be covering today, firstly, maybe just one other, sorry. I had somebody talk there. One other, yes, I see Tari mentioned that you're welcome to post questions in the chat, and Tari will maybe alert me or one of the Tech Tribe colleagues, when there's one that's pertinent that we can handle at that point in time. Otherwise, I'll also take a few questions at the end. And also to mention that the Tech Tribe team will distribute a PDF of all the slides that you'll see today afterwards. So, no need to try and scribble down a lot of notes. You can rather just concentrate on what we're talking about. But yeah, firstly, we'll start with the concepts, and after that, we will have a look at the big three financial statements: the income statement or profit and loss statement, the balance sheet, and the cash flow statement. And then I'll just take you through a few examples of how to look at these statements and see what type of information you can gain from them, what type of insights you can get from any business just from looking at their financial statements. Then we will talk a bit about how to analyze financial statements, just some basic tools there. And then we'll do some analysis exercises, and you'll get the opportunity to try your own hand at doing analysis of, doing some financial analysis. So yeah, that's it for the day. So in terms of the concept section, firstly, I want to briefly talk about the origins of accounting, which is quite interesting. Then the basics of accounting, the fundamental concept in accounting is really double entry bookkeeping. So we'll talk about what that's all about. Then I want to talk about the difference between gross and net. And also, what's the difference between profit, margin, and markup? Because people throw around these terms. They sometimes confuse them. They sometimes mean the one, but use the other word. And it's important to understand what you're talking about if you want to use this terminology to understand, your own business's financials and those of others. So to kick off things, the origins of accounting. The first, the ability to count things is something that's so central to humanity that we don't even give it a second thought these days. But it had to start somewhere. And the interesting thing is that the current oldest example or proof or evidence of humans doing some counting is what's called the Lebombo bone, which was discovered on the border between Swaziland and South Africa about 41 to 42,000 BCE in the Upper Paleolithic period. So this is interesting because, as you probably know, we talk about the cradle of humankind, the oldest hominids, sort of human ancestors, evolutionary ancestors were also discovered in Southern Africa, and in fact in South Africa in the cradle of humankind. So I guess we shouldn't be surprised that some of the oldest evidence of counting also comes from here. Then around 28,000 BCE, there was another bone. Well, a bone from that time was discovered in the Czech Republic, and it's called the wolf radius, which had, some counting marks on them. And then around about, dating from around about 18 to 20,000 BCE, there's what's called the tally stick, which was discovered in the DRC, which had specific numbers on them like 48 and 60 marks. They're still arguing about what those mean exactly, but it's definite evidence for counting or accounting. And accounting is just, as the word implies, it's the counting of things. It's accounting for what's there and what's not. So yeah, those were the sort of the earliest start for accounting. And then, once agriculture developed, the domestication of plants and animals, the need for accounting for things increased substantially. And these, let me just get a pointer going here. So what you see here are clay tokens dating from about 7,500 BCE from Mesopotamia. And they used the shape and the size of these tokens to denote different types of plants and animals. And they made marks on them to count. And what you have here at the right is sort of a primitive ancestor to a safe or to an envelope, a sealed envelope. What they did was they actually put these little clay accounting tokens inside a clay ball, and they fired that. So they baked that clay so that it is sealed, and so that people would only break open this clay ball at a later time when they needed to review what was accounted for. So that was a way to safeguard, to prevent tampering and somebody cheating in terms of what someone owes another person. But if you think about it, different shapes of tokens with different markings on them, this was really the beginnings of writing. So it seems like the need to account for things might have been the original impetus for humans to start developing writing. So that's really interesting. Then after that, moving on in time, if we get to about the time of Rome, the Roman Empire, people started writing on stone and papyrus. And what you see here is actually an account of all the spending of Caesar Augustus over a 30 or 40-year period. So this was extensive accounting for expenses already by 2,000 years ago. And from there, just 100 years later, we already have a Roman talking about disbursements on one page and expenses, receipts and expenses on the other side. So starting to talk about the double entry system of accounting, really, of things that need to balance in accounting. Then around about the 8th century, in the Common Era, so by 700 or 800 after Christ, the Persians actually developed the double entry system for the first time. But in 1494, a person named Luca Pacioli wrote a book with a whole chapter on the double entry accounting system. So this was really the first written document that set out in detail how to do double entry accounting. So yeah, that's all I wanted to cover. I thought it was quite interesting that where the origins of counting and the fact, how it developed. So then we've spoken about the origins of accounting, and the origin, or where the double entry system originated. But what is double entry bookkeeping really? What it is about is that for every single transaction that you capture in the books, you always make two account entries, a debit and a credit. And if you want to remember which side, the debit is on the left-hand side and the credit is on the right-hand side. So maybe that's a way to remember. The R in credit stands for right. So remember that debit is left and credit is right. And the idea is that for every single transaction, you always make an entry into two accounts. So that leads us to what's called the fundamental equation of the double entry bookkeeping system, which if you've done accounting in school or at university or at college, you might be familiar with already. And that is that assets must always be equal to equities and liabilities. And we'll have a look just now what these mean. Assets really talk about the uses of funds, and equities and liabilities talk about the sources of funds. So the sources of funds mean where did your business get the money to operate? And on the asset side, you have what did your business use the money on? So if we look at what's contained within these sort of bins or these buckets called assets, equities, and liabilities, equities is really about inbound investment and also gains or profits from previous years, because those come into the business and they become available to be used. That they are sources of funds that become available to be used. And liabilities are really about loans, so short and long-term loans and other means of getting money into the business. Whereas with assets, you talk about things like cash, outbound investments, physical assets, and then also intangible assets. So if we're talking about the double entry accounting system, think about the debit and the credit. So we'll always, for every transaction that happens, we will make two entries in the accounts. So for example, we might debit an asset and credit an equity, or we might debit an asset and credit a liability, or we might debit one asset and credit another asset. There are really 7 basic types of accounts. There are the assets, there are the equities or capital, there are the liabilities, there are the revenues and expenses, and there are the gains and losses. So if you notice here, assets are sitting on the left-hand side or the debit side. We have equities and liabilities and gains and revenue all on the credit side. And we have expenses and losses on the debit side. So this is something that you just need to learn and that you just need to remember. But there's a useful acronym to help you remember this, and it's called DEAD. It says debit, expenses, assets, and dividends, and everything else is credited. So, this is a way for you to remember. So if you, to increase an asset account, you will debit it. To increase a liability, you will credit it. So if you debit a liability account, that means you will reduce the liability. If you credit a liability account, it means you will increase the liability. Whereas for expenses, assets, and dividends, they sit on the debit side. So if you debit an asset, you will increase the asset. So that if you're not familiar with this already, it might seem a little bit confusing, but just remember this acronym. And I'll show you some examples just now that might help you understand it a little bit better. So let's look at a few specific events. Let's say that you buy raw material for cash in your business. This has an effect on two assets actually. The one is that your inventory increases because you now have this raw material. The second one is that your cash decreases. Remember that when you debit an asset, it increases. When you credit an asset, it decreases. So when you buy raw material for cash, your inventory will increase and your cash will decrease. And note that you are now following the rule of double entry bookkeeping, which is two accounts must always be affected for every action. We are affecting two accounts and we're debiting one and crediting another one, which means our accounts will balance because the assets will actually remain at the same value. One asset will increase by a certain amount, another asset will decrease by the same amount, which means the assets stay constant. So we will continue to honor that fundamental equation of assets equaling equities and liabilities. So if we look at a different event, let's say that we don't buy the raw material with cash, we actually buy it with credit. So now our inventory still increases because our raw material has increased, but our cash didn't decrease because we're buying it on credit. But our liabilities have increased because we still owe the money. And we are crediting trade payables. And remember that liabilities grow bigger when we credit them. So the trade payables now grow bigger and our inventory grows bigger. And you see here, we're debiting inventory and we're crediting trade payables, which is a liability. So we're doing the double entry. We're entering something on the debit side and something on the credit side. And this equation, assets equals equities and liabilities, will still be honored. So what happens later on when we pay now this trade payables invoice that we received, if we actually pay it? Of course, now our cash reduces, so we credit cash again, and we debit trade payables. And remember that liabilities decrease when you debit them, so our trade payables will go smaller. In other words, we're going to be owing less money because we owed that amount of money, but now we pay it with cash, and that will decrease the trade payables, in other words, the money that we still owe. So I hope those examples give you a good feel of what the double entry accounting is, or at least an introduction to the concepts. Next, I want to talk about gross versus net, which is also something that sometimes causes confusion. So when we look at our income statement and profitability of the business, we start with the revenue or the net sales. Now, in this context, net sales, net means net of something. It means after deduction or accounting for something. And what the term net sales means is that it is your sales, the sales that your business has made, net something. And what that something is net returns and discounts, trade discounts and taxes. Because, if you, for example, VAT, VAT isn't part of your income, it's a tax or duties and taxes and these sorts of fees. So you just have to adjust your revenue for those sorts of numbers that isn't really revenue. Things like discounts. If you sell at a discount, you don't receive the original amount of money, you receive the money after the discount. So that's what the net means in this context. But if you want to talk about gross versus net, you start with your revenue. And from the revenue, you deduct your costs of goods sold. And those are really your direct costs. Those are your raw materials and your direct labor that's directly related to that revenue that you've generated. If you're providing a product, it includes raw materials. If you're providing a service, then it's the direct cost of providing that service. And if you deduct the cost of the goods sold or the direct expenses from your revenue, you get the gross profit. If you then deduct your operating costs or your operating expenses, which is your non-direct expenses, things like overheads. You might have electricity bills for your building, you might have human resources staff, you might have stationery, all the other expenses that's not directly related to your main business, to your selling of your products or services. Those are called your indirect costs, those are the other operating costs. If you deduct that from your gross profit, you get the operating profit. And finally, if you deduct the non-operating costs, which could be things like interest on loans, things that are not really to do with your core business. It might be to do with how you finance your business or other non-operating activities. If you deduct that from the operating profit, you get to your net profit, sometimes also called the net income. So that's the difference then between gross profit and net profit. Gross is what is your profit after your direct costs? The direct costs that are directly related to delivering your product, your service, or manufacturing and delivering your product. Then you have the operating expenses and the non-operating expenses, and you get to your net profit, which is your final profit after accounting for all expenses in the business. Okay, so if we then look at profit, margin, and markup, and I think, unfortunately, I can't keep the chat open because then I can't see my screen properly. So if I can ask the Tech Tribe team to please interrupt me if there's a pertinent question, that maybe a lot of people have that I can explain, when I'm on this point, so that I don't move on if somebody doesn't understand something. But yeah, so now I'd like to talk about the difference between profit, margin, and markup. So we've already looked at this where we talked about profit. So profit is the actual number. It's a number in the currency, in dollars or in rands or in whatever currency you work in your country. The difference between profit and margin is that margin is a percentage of revenue. So that helps us to relate between businesses and more easily understand the level of performance of a business better than the value in a currency. So if we, when we talk about gross profit, that is a specific number in a specific currency. If we talk about gross margin, that's a percentage, and it's the gross profit divided by the revenue. It's the gross profit divided by the revenue. And the same then with operating margin and net margin. Operating margin is operating profit divided by revenue. Net margin is net profit divided by revenue. So all of these related back to the revenue. And later on, we'll look at some examples of actual financial statements and look at how we calculate these and the value of these. In fact, I can show you an example now, and this is for Apple. And this was published by themselves in their, this was their own way of reporting. And you can see that at the top they report profits and at the bottom they report margins, because both are of interest. So in the top it's millions of US dollars. In the bottom it is expressed in percentage. And now you can see the value of talking about margins, because we can see that their gross margin is 40%, which is actually quite high for a business that for a hardware business that manufactures products. It's more in line with what you would expect of a service business. But of course, Apple has a huge component of services as well through the iTunes, through the App Store and iTunes and so forth. But there you can see the gross margin, the operating margin, and the net margin. And they have over 20% net margin, which is very healthy. So Apple is, these are old financials, but we know that they're still a healthy business. So you can see the value of both the profits in numbers, 53, that's actually $53 billion, and a 22 or 20, just about 23% net margin. So it already tells you something about the operating health of the business. Yeah, so there you can see the direct costs, you can see the indirect costs, the gross margin, the net margin. You should be familiar with these by now. So then we've covered now the difference between profit and margin, but what's the difference between markup and margin? People throw these around and there's a lot of confusion about these two. I prefer margin, but I'll get to the reason why just now. So markup is a ratio. It can be any number. It can be more than 100%. Whereas margin is a proportion or a fraction. It can never be more than 100%. So for markup, for both markup and margin, you have gross profit above the line. But for markup, you divide by the cost of goods sold. That's why markup is a ratio to the cost, whereas margin is really a ratio to is based on price. So markup is based on cost, revenue is based on price. And I'll illustrate the implication and the difference between the two by going back to what we said earlier about revenue or net sales. Remember that revenue, you can break down revenue in two parts. The one is the cost of goods sold and the other one is the gross profit. And those add up to the revenue because the gross profit is equal to revenue minus cost of goods sold. So you can represent it like that. The markup then is the gross profit divided by the cost of goods sold, whereas the margin is the gross profit divided by the revenue. But we know that the revenue is equal to gross profit plus cost of goods sold, so we can write it as gross profit plus cost of goods sold. So I'm going to change the ratio now between gross profit and cost of goods sold. So keep your eye on that. And then also have a look at what happens with markup and margin when we change that ratio. So say that we have a very high gross profit, then the cost of goods sold is less. That's the reason for the high gross profit. So now cost of goods sold is smaller than gross profit. So you can see that that's why the markup number can be more than 100%. If we look at margin, the gross profit is divided by the total revenue. And the gross profit item can never be bigger than the total revenue. That's nonsensical. You can't make a bigger profit than the total income that you've gained. And that's why gross profit can never be more than 100%. The problem with markup really is when you get to very high gross profit levels, you can see that markup now will be like 900% or something like ridiculous like that. When the cost of goods sold becomes very small, then markup is really distorted, and you can have very high markup numbers, and it's difficult to relate to that. I mean, what does a markup of 600% really mean, and how much is that different to a markup of 200%? It's actually not that different. That's why I prefer margin to avoid misunderstandings when people talk to each other about markup and margin and all these things. People sometimes use markup because the old idea of the fact that you have your cost and then you have a certain markup on that because you want to make a certain you calculate it based on your cost. But if you attended the other masterclass a month ago, or even if you haven't, just to state that basing your selling price on cost plus markup is almost always a bad practice. You should base your price on the value that's delivered to the customers and based on what you can achieve in the marketplace, the perceived value, what competitors are pricing it at, and so forth. You shouldn't be basing your selling price on cost, because in principle the selling price has no relation to the cost. It has relation to the value delivered to the customer and what the customer is willing to pay for that product or service based on the value to them. And that's what you should base price on. So even from that perspective, markup is not a good way to calculate what your selling price should be. So that's why I prefer margin. It's a clear metric, and because it's always a fraction of 100%, so everybody can relate to that. If we say my gross margin on my service is 40%, everybody understands what that means, and everybody can relate to that. Good, so that's the end of this session, profit, markup, and margin. And really the concepts that I wanted to cover that you need to understand to be able to read and understand your financial statements. So we can now move on to the big three financial statements. And I'm going to give you a summary of what each of these statements mean, a definition for each, and their purpose, what they're used for or what they're useful for. So firstly, the income statement. This is to do with the financial performance of an entity over a specific period. It shows the revenues and expenses, both operational and non-operational. And its purpose really is to answer the question, did the company make or lose money over a specific period of time? The second big financial statement is the balance sheet. And that shows the financial position of an entity at a specific point in time. It's really a snapshot at a specific point in time of the entity's financial health. And it's structured according to that fundamental equation that we've already spoken about, that the assets must be equal to the equity and liabilities. And from the balance sheet, you can gain or glean quite a few things. It answers a set of questions, including what assets does the entity own? How did it pay for those assets? What money does it owe, its liabilities, and what is the amount left after satisfying those liabilities? And as I said earlier, the balance sheet is really at a specific point in time. One thing to note is that a company can have fantastic financial performance but still be in a bad financial position, or it can have poor financial performance but be in a good financial position. These two things don't always correlate. Over a long period of time, they will tend to align, because if you continue, like, you might be in a good financial position, in other words, you have a lot of money in the bank, but you run the business poorly and you make a loss every year. Over time, that money in the bank will be eroded, so your balance sheet will get worse and worse every year. So they definitely influence each other. Well, at least the income statement influences the balance sheet over time. But at one specific point in time, it's possible for these two, for a company to be in a good financial position but still have poor financial performance, as an example. The third big financial statement then is the cash flow statement, and that is a summary of cash inflows and outflows. And you've all heard the terminology that, or the saying that cash is king. If you run, and that's especially if you run a small business, because you tend to not have a lot of resources, a strong balance sheet with a lot of cash in the bank to fall back on if you have a cash flow shortage. So management of your cash flow is a critical thing. I've seen Buntu talk about that in the lead up to this masterclass as well. Cash is really the lifeblood of your business, and if you don't manage your cash well, you can end up in a world of pain, and your business may even go down the tubes. So it's really important to keep an eye on your cash flow, and that is what the cash flow statement is all about. It helps you to keep an eye on that. And it answers the questions: how much cash was generated by the entity over a specific period of time? And how did changes in the balance sheet and income statement affect the entity's cash? Because you can generate cash or use up cash both with income statement and with balance sheet activities. And with income statement activities, I mean, the revenue and the direct expenses related to your operations of your business. It could also be your overhead expenses. If you have too big fixed expenses, things like salaries and these sorts of things, and your revenue doesn't justify that, it will eat up your cash. But you can also, your cash position can also be influenced by activities on the balance sheet. For example, if you raise a round of investment, that will inject cash into your business. Or if you take out a long-term loan, or if you raise, you get paid by your customers, but you delay paying your suppliers, that will have an influence on your cash position. Good. So that was the overview of the three statements. So let's look at each of these three in a little bit more detail. So the income statement, we start with the net sales, and remember the calculation of the net profit that we looked at earlier. And the income statement is to do with the profitability of the business. So this is really just an expansion of what we did there when we calculated gross profit, operating profit, and net profit. And you'll see that in every income statement. That's the basic structure of an income statement. So we start with that net sales, and as we said, net of taxes, returns, and duties. We deduct the direct costs, the cost of sales, the cost directly attributable to the products or services. We get the gross profit. We deduct the operating expenses. We get the operating profit. And another term for operating profit is EBITDA, or earnings before interest, tax, depreciation, and amortization. So that's really to do with the question of, is the operations of the business profitable? And that's why a lot of financial analysts prefer this term, or prefer looking at the operating profit or the EBITDA of a business, because the non-operating expenses aren't really to do with the core of the business. They want to know whether the core business is profitable or not, the operations of the business. But after you then deduct the depreciation and amortization, so just to say that amortization is the same as depreciation. The only difference is that you depreciate tangible assets and you amortize intangible assets. So after you deduct the depreciation and amortization, you get to the earnings before interest and tax. And then if you deduct the non-operating income or expenses, you account for that. you get to the earnings before tax. So non-operating expense example might be interest on a loan that the business has to pay. Then you get the earnings before tax after you deduct those non-operating income and expenses. And then if you deduct the tax from that, you get to the net profit. So this is the basic structure of all income statements. You should be able to recognize that in anybody's income statement. Sometimes they use different terminology like revenue or turnover instead of net sales and so forth, but the basic structure remains the same. Moving on to the balance sheet. As we said earlier, the balance sheet is really this fundamental equation of accounting, of the double entry accounting system. The assets must be equal to the equity plus the liabilities. And under the assets, we can have current and non-current assets. So the current assets might be things like cash, short-term investments, accounts receivable, that's money owed to you by customers. Maybe you have some VAT refunds coming in, things like inventory. On your non-current assets, you have fixed and intangible assets. Fixed assets might be property, plant and equipment, furniture and fixtures, and long-term investments. And then your intangible assets consists of your intellectual property and goodwill. And goodwill really is to do with the premium a company pays when they acquire another company. That's actually related to the intangible assets, the intangible value in the business over and above the assets that are accounted for in the balance sheet. Then if we look at the equity component, that consists really of two main items. The one is the shares. So if you issue shares, people pay to buy those shares from the company. That is money that comes into the company, and that is under equity. But also then retained earnings or income, and this is basically the net profit minus any dividends that might be paid. So this item is how the income statement communicates with the balance sheet. So if you make a profit on the income statement, that will come in here as additional equity because it really increases the value, the equity in the business for the shareholders. And if you're making a loss, that will reduce the equity because it's eroding the value in the business for the business owners. And then we have the liabilities. Those consist of the current and the long-term or non-current liabilities. Current liabilities is money that you owe, like you've received invoices from your suppliers and you haven't paid them yet. Those would be the trade or accounts payable. You might have tax payable like VAT and short-term debt. And then in the long-term or non-current liabilities, you will have things like long-term debt and contingent liabilities, making provisions for lawsuits and things like that. The third statement then, the cash flow statement, that's all to do with cash inflows and outflows. And what we're talking about really is the cash pool of the business. How much cash do you have? And the question is, when we're looking at the cash flow statement over a period of time, we want to say, how did the business generate cash, or how did its cash reduce or erode over a period of time? And there are three ways in which the cash of a business can be influenced. It can be influenced through its operating activities, that the main operations of the business, the sales of the products and services. It can be influenced by investing activities. You might invest in a plant, you might invest in other businesses. That might cause cash outflows, or you might then sell assets again. You might sell the plant, you might sell your investment in another business, and that will generate cash again. And the third area where you can generate or lose cash is in your financing activity. So that's all to do with raising investment in your business and or making or lending money. Borrowing money from other parties to increase the cash in your business. So under the operating activities, really you have the cash received from sales of goods and services minus cash paid to produce and deliver the goods and services. Under investing activities, you have cash received from sales of investments and capital minus cash paid to purchase capital and where you invest in other businesses or in investment entities. And the financing activities, that's cash received from borrowings or by issuing shares. The Americans talk about issuing stock in your business, but it's really issuing shares minus cash paid for dividends, debt, or repurchasing stock. So those are all the things that can influence the cash in a business. I'm not going to go into the details of how it's calculated here. You will get the reference to this in the PDF handout if you want to refer back to it afterwards. So that's really a very quick overview of the big three financial statements. I can maybe mention, it's obviously not possible in 2 hours to cover everything in a lot of detail. So I'm hopefully just giving you a level of awareness of the structure of all these things to enable you to go back afterwards as well. And if you do your own reading further on, to give you a basic understanding of what's there and an awareness, so that you at least know where to look and you start to become familiar with the terminology. I can also mention that there's a whole course on how to understand and analyze financial statements presented by the Moolman Institute. It's an online course, and there's a 20% discount for Tech Tribe community members, and links to those courses will also be in the PDF that you'll receive afterwards. But moving on to, oh yeah, sorry, I think we can take the break maybe at 11 o'clock. I'm gonna that's what that's all about. I'm gonna go straight to the financial statement examples now, and then we can break for a quick bathroom break at 11 o'clock. So I'm going to work through a specific example and illustrate a few transactions and the things that happen, the impact of those transactions on the three financial statements, to give you a better feel for what happens in practice. I'm going to talk about a factory called Factoria and their customer, a company called Distributech. And we're going to look at a few events that happen, some transactions between these two companies, and I'll illustrate what happens in the three financial statements, the income statement, the balance sheet, and the cash flow statement for these simple events. So the first event is an invoice. So let's say that Factoria has delivered some products or services to Distributech, and they send an invoice to Distributech. So the event is that an invoice has been sent. What happens on Factoria's side is that the invoice, because a customer has been invoiced, that immediately shows up as an increase in income on the income statement, which will immediately increase the profit, because just this event, we're not talking about the event where we account for the cost of this sale on the income statement. We're just talking about the sending the invoice. That increases the income, which increases the profit. You will also assign typically an expense, a cost to that income, but typically your expense related to that income will be less than that income, so that will increase the profit, the bottom line of your income statement. And if we look at the balance sheet, we will always be making the two entries there. The one is that because the income has increased, which increases the profit, we have the retained earnings increasing as well, and that's on the equity side. So remember, a profit is on the credit side. On the equity side, that increases your retained earnings. At the same time, we increase the trade receivables on the asset side, because money being owed to you is an asset, so the trade receivables increases. So that's the two entries on the balance sheet, and those two will balance. So your assets increase and your equity increase. On the other company side, in Distributech, there's a different impact on their financial statements. They receive this invoice, and immediately they have to increase their expenses on their income statement, which decreases their profit. And on their balance sheet, they have the double entry then, an increase in the trade payables, which is a liability because they now owe this money. Distributech owes this money to Factoria, and they decrease their retained earnings, which is equity, because that decrease in profit erodes the equity of that company. So you have an increase on liability and a decrease in equity, both on the right-hand side of that asset equation. So assets equal to equity plus liabilities, you have an increase in liability and decrease in equity, so it all balances out. So your balance sheet still balances. But note that even though there was an entry in the income statement, we've made the double entry in the balance sheet, there is no impact on the cash flow statement. We have no entry in the cash flow statement because no cash has changed hands at this point in time. So let's say now a little bit later, and Distributech actually pays for this invoice. So money changes hand, payment is made. So what's the impact now on the financial statements? At this point, there's no impact on the income statement because we've already accounted on both sides for the income on the one side and the expense on the other side. However, on the balance sheet, there is an impact because we previously had an entry in the trade receivables, but now the money has been paid, so we decrease the trade receivables. That money, Distributech no longer owes that money to Factoria. We decrease the trade receivables by the amount of money received, and we increase the cash because we've received the actual money. So you see now there's a decrease in an asset, an increase in an asset, and again, your balance sheet balances. On the other side, in Distributech, the impact on their balance sheet is they decrease the trade payables, which is a liability. They no longer owe that money to Factoria, but they also decrease cash because they paid the money. And therefore, you have a decrease in a liability and a decrease in an asset, and that still balances on the balance sheet. But now we do have an impact on the cash flow statement because money has changed hands. Factoria's cash has increased because there's an increase, there's a cash inflow, and Distributech cash has decreased because there was a cash outflow. And I'll illustrate this through another example, just looking at it in practice. And let's take Factoria, this same example where Factoria delivers a product or service to Distributech. But let's say we start in the first month, and I'm just going to show you the impact on profit and on cash flow, because sometimes people also confuse the two. They confuse profit with cash. And even though in the long term, these two things correlate, in the short term, they don't necessarily agree. And I want to illustrate this through some simple activities in the company. So let's say that the Factoria has received an order from a customer. So they don't have the raw materials in stock, but they order the raw materials. The raw materials are delivered, and their supplier issues an invoice. So the impact on the income statement is that as soon as they receive the invoice, they make that entry into the income statement. There's an expenditure of $1,000 reflected on the income statement. Let's say it's $1,000 for the raw materials. It's minus 1,000. The profit then at this point in time, income of $0 minus $1,000 expenditure, is a profit of minus $1,000. And the cumulative profit at this point is minus $1,000. There's no impact on the cash flow statement. No cash has changed hands. So let's say now in month 2, the factory is now manufacturing the products because they've received the raw materials. So it's manufacturing in process. Now they have to pay the labor costs, and that's an expense in this month, in the second month. And say that the labor expenses are $2,000. They still haven't received any income. They haven't even delivered the product yet. So there's in this month, they have an expenditure. They account in the income statement for the labor cost of $2,000. That means a profit this month of $0 income minus $2,000 gives you a minus $2,000 profit, or a loss of $2,000. And now the cumulative profit is actually a cumulative loss of $3,000, because remember, we had that loss of $1,000 in the first month. We lose another $2,000 in the second month. We now had a loss of minus $3,000. But in this month, there is an impact on the cash flow statement because we paid the 2,000 labor cost, and we paid that invoice that we received in the first month. In the second month, we pay that invoice. So there's a $3,000 cash outflow. So let's say that in month 3, we actually deliver that product to the customer. We have a delivery note. We can now issue an invoice to the customer, and we have a 50% margin, gross margin that we make on this product. So we actually issue an invoice of $6,000 to the customer for this product that we delivered, this product that actually cost us $3,000. So immediately when we issue that invoice, this is reflected on the income statement. So we reflect an income of $6,000 on the income statement. No expenditure in this month related to this specific product. And that means in this month, we make a $6,000 gross profit. Our cumulative profit now, when you add $6,000 to minus $3,000, is a gross profit of $3,000. So when we look at the income statement after month 3, things are looking pretty rosy. We're making a nice profit there of $3,000. But note that the customer has not yet paid the invoice. So we're still down $3,000 on our cash flow statement. We're at negative $3,000. And let's now say that this customer is a bit late on payment. And by the end of month 4, they still haven't paid. On the income statement, we're still showing 3,000 profit. On our cash flow statement, we're still at minus 3,000. So if we look at the total for the period, you can see there's a discrepancy between the income statement and the cash flow statement. And that's because generally in a business, in an operating business, you have to deliver services, products and services first before you can receive payment for that. And this difference really is what's to do with when they talk about working capital, that the business might require working capital. It's to do with funding this difference between what the profits that you're making on the income statement and really what you need to operate the business, that delay between delivering the products and services and getting paid for it. And keeping inventory in your company. Those things all cost money, and you're not making money on them yet until you've sold them to the customer and until the customer pays. And this also shows that how a small company can be vulnerable to, if they have like, if you depend in your business on one big customer, let's say, and that customer goes bankrupt at the point where they still owe you a lot of money, or they just delay payment, and your suppliers are clamoring and giving you calls and saying, pay us immediately, or we're going to stop delivering raw materials because you haven't paid us, and you are stuck because your customer hasn't paid you yet. That's all to do with the cash flow health of your business. And that illustrates why it's so important to keep an eye on that and manage that well. Yeah, so now I'd like to look at, I think maybe we'll take that break now. And after the break, I'll talk you through some examples from public company financial statements that you can go and have a look at on the internet and show you. I'd like to work through them and show you that they really look exactly like like the structure that I covered earlier for those 3 statements. And hopefully you'll start recognizing, these, when you look at these financial statements, they might look complicated initially, but once you know what to start looking for, you'll really pick up easily those headline items that should be in an income statement, should be in a balance sheet, and should be in a cash flow statement. So I think let's take a 5-minute bathroom break here. I see it's now 10:56, so I think exactly 1 minute past 11, if we can say that, but exactly 5 minutes from now, we're going to kick off again. I'll also take the time now to have a look at the chat and see if there are questions that I maybe can cover when we start again. So welcome to take a bathroom break now. Thank you. I think let's kick off and I'll try and answer those questions. The first question is from Clement. And oh, by the way, I mean, I just read through the chat, and it's fantastic to see people joining from so many countries in Africa. It's really great. I mean, this is the non-ideal thing about these online master classes or courses or webinars is that, we can't have the human-to-human interaction in person, which is, and some of that networking and all of that. But the big benefit is that we can have people from all over the place participating. So it's fantastic to see people from all across Africa, and it's really great for the Tech Tribe community. I think it's great that us Africans can all support one another in building, growing and successful businesses in Africa. And entrepreneurship is really, the world is becoming so, it's the old days of working for one company for 40 years is long gone, and there's a lot more pressure on everybody to create your own job. Really, you have to, more and more people have to be entrepreneurs to survive, and so it's becoming an important skill. And it's great to see so many people from all over Africa participating. So the question then from Clement was, for training and consulting business with no fixed contract or customers, how can financial projections be made? Well, if you it depends also on where the company is in its development status. If it's companies might be pre-revenue or post-revenue. Pre-revenue means that you haven't made any sales yet. Post-revenue means that you have some sales already, but it might go up and down. So if you post-revenue, in other words, you're already making some sales, but it's a bit unpredictable, that's a bit difficult to manage. The one thing you can do is look at your historical averages. The other thing you can do is you just have to make forecasts for the future, just like pre-revenue businesses. And I do cover in one of the financial modeling courses how to do revenue forecasts in different ways. You can look at, for example, at other small businesses in the same industry. You can estimate based on, for example, in service businesses, it depends on whether you a B2B business or a B2C. If it's B2B, for example, you can estimate based on the number of sales staff you have and the typical hit rate. 1 out of every 10 of these contacts, you would have a sales funnel, and you would have success rates that you start building up from historical activity. And based on that, and how many people you have in the team that's handling that, you can start making projections about the future, and in terms of your investment in sales staff and so on. And maybe you have some ideas on how to improve your conversion rate between customer contact and making an actual closing a sale, and then you can improve or increase your predicted conversion rate in future and so on. But yeah, there's really no other way to do it than to look at the historical information, look at what's realistic in terms of similar types of businesses, what they've been able to achieve, the sort of selling price and selling volumes for similar size businesses, and then trying to make projections on that. If you pre-revenue, it's even more difficult to do that. But again, there are methods that you can use to try and make those projections based on, as I said, looking at competitor pricing, or the pricing of competitors and alternatives in the same marketplace gives you an idea of the price that you should be able to achieve. And then in terms of sales volumes, there are top-down and bottom-up methodologies. The top-down methodologies are some of the more infamous ones, because everybody kicks off and says, oh, but storage is a 7 billion rand business in South Africa, and we're going to capture 1% of that, so we're going to make sales of 70 million rands next year. And that's of course typically quite unrealistic. A bottom-up methodology is to do with looking at what is actually required based on, even if you're a pre-revenue business, you should have at least started talking to customers and trying to get any of them interested in a pilot or initial sale or testing of your product or service. And you should be, if you talk about the lean startup methodology, that minimum viable product, you should be trying to get it out there. You should be talking to customers all the time. So based on that, you must be able to get a feeling for how long it takes you to contact a new potential customer, how many contacts are required, how many people in that organization you need to talk to, the sales cycle, how long does it take for you to close a sale, or how long do you think it will take you to close a sale, and how much of your effort will be required for a sale, and what will the value of that sale be. And based on those sorts of approaches, you will be able to make to do financial projections. So financial projections you'll do from historical financials, comparable company financials, and from your own projections based on what you have learned and you understand is realistic. There's another question. What are investors looking for when they read through a financial statement? And do you have courses for financial management for business owners? The second part is the easier part. Yes, there are courses. There's a whole 4-course series called Financial Modeling for Entrepreneurs and Innovators. And that really covers all of these things, the fundamental financial concepts. It covers financial statements. It also covers how to build your own financial model for your own business, or how to make financial projections, and really interlinked or weaved interweaved throughout those 4 courses. All the time I'm talking about what the things that are important for early stage entrepreneurs or small businesses in terms of the financials. In terms of what investors are looking for when they read through financial statements, well, again, that depends on the stage of the business. If it's really, obviously, if it's a pre-revenue business, they cannot look at revenue or the history of revenues for that business. All they have to look at is the expenses and how you're running the business. So they would be interested in how you're managing your cash flow. Like, presumably you had some investment going to the business in the beginning, even if it's your own money. Family and fools, that have funded your business up to there. You had some money come in. You have spent that money. So the question is, how did you spend that money? What's your balance sheet looking like? How healthy is the company's financials at that point? How much runway do you have left? In other words, at your current rate of expenses, how many months worth, and usually it's months, not years, if you're a typical startup, how many months worth of expenses do you still have in that business? How long can you go before you need to raise investment again? So they'll also be looking at, what are you spending the money on? What type of expenses? Do you have big expensive offices? Did you spend a lot of money on nice signage and brand and things like furniture and lots of nice top of the range computers for all the staff members and all those sorts of things? Because they want to know, when they give you money, are you going to manage that money responsibly? Are you going to be frugal and look after their money when they give you that money? So that's the type of thing that they will look at in the financial statements in the early stage. If you're pre-revenue, they will look at, what are you spending the money on? What have you spent the money on? Are you managing your cash properly? What's your expense run rate? When will you run out of money? Those are the things that they look at. But they won't just look at that. They will ask you about that. You need to understand those things well. You cannot get in front of an investor and not know what's going on in your own business on the financial side. I mean, that's just not on. You have to understand what's going on there. So that's what they will look at in a pre-revenue business. If you're already making some money, then they will start looking at other things like profitability. Are you profitable at this point in time, in terms of, for every unit, it's called unit economics. We don't have time to go into that in detail, but on a single product or single set of service delivery, single invoice, customer invoice basis, are you making or losing money? Now, in the early stages of a company, when you in the early stages of earning some revenue, you might be losing money on every unit of product or service. And that's especially true when it's a service business where you have a big customer acquisition cost. In other words, it costs you a lot of money to acquire each customer, but they will be paying you a monthly fee over a long period of time, so-called annuity revenue. So in those businesses, your initial expense in acquiring that customer and the initial money you spend in onboarding them and delivering the services to them might exceed the initial income. So therefore, you might be running at a loss, but actually the business might be healthy because you're building up some big annuity revenue, and later on, that annuity revenue is going to be very valuable for your business. So that's the type of thing that investors might start looking at post-revenue. But they also look at all the other things that I mentioned for pre-revenue, things like how you're managing your cash, how you're spending the money. Are you spending it on R&D and things that you should be spending it on, and investment in growing the business, or are you spending on vanity things like a big office for the CEO? So, and also things like, what is your run rate? What is your fixed expense burden? How many staff members do you have? What's the cost of the staff members? What's the cost of the offices and these things? And are those things really at an appropriate level for the size of the operation and the income that you're generating? Because they also don't want to invest a lot of money and all of it goes to fixed operating expenses that are not contributing to growing the business and growing the value for them, because they obviously want value. They want a return on that investment, so they want to know that money is going towards growing the business and growing the value of their shareholding. So that was quite a long detour, but I hope that's useful to all of you. I see there was another question. Can you briefly cover the calculation of GMV? And I must say that I don't know what GMV stands for. So I don't know if somebody can quickly type there. I'm not familiar with the term GMV. Gross something value, gross merchandise value. Okay. I don't actually, I'm not familiar with that term. I've never come across it, so I can't say how that relates to gross revenue for marketplaces. Sorry. Maybe we can get to that at the end if somebody defines what that term means. But in the meantime, I think let's continue. So here we have an income statement of Snap, which is the maker of the Snapchat app, and I want to point out a few things that should be hopefully a little bit familiar by now in their income statement. Firstly, we have total revenue. So you see there, this was the last financial year for this statement, but they also had the previous 2 financial years there. But you can see their total revenue. So that's the same as net sales. We have the cost of revenue. We have the gross profit. So they did make a small gross profit there. Then we have the operating expenses, which was over 4 billion, because this is in millions. And you can see that the operating expense is a lot bigger than the revenue. We can also see in the previous years that there's been a big jump in the operating expense from 900 million to over 4 billion. And because of that big operating expense item, we have a operating loss, because the operating the revenue, the income was only 800 million, and with a gross profit of only 100 million, but operating expenses of over 4 billion. So this shows that they're operating at a huge loss. When we get to their balance sheet, you will see that might give us some more insight into what, into why this is happening. What's these big numbers there? And you can see already that there's over 1.5 billion in research and development versus 180 million in the previous year. So clearly, in terms of selling and research and development, they're investing a huge amount of money. And the balance sheet might give us some insight into where did that money come from, because certainly in the previous years, they didn't make profits. So they can't be funding these big expenses from previous year profits, but the balance sheet will show us where that money is coming from. So revenue minus cost of revenue, or the cost of goods sold, gives you gross profit, minus operating expenses gives you operating income, or an operating loss in this instance. And then if you subtract the non-operating expenses, or you adjust for that, you get to the net income before taxes. Because they're making a loss, they don't have a tax expense, they only have a small provision for tax, and that gives us a loss of over just about $3.5 billion. So you can see the familiar basic structure of the income statement. It's just revenue minus the expenses until you get to the net income, or net profit, or net loss in this instance. So if we move on to the balance sheet for Snap, on the left-hand side here, we have the assets. On the right-hand side, we have the equity and liabilities. And what we see is that total assets of 3.4 billion is equal to total liabilities and equity. The sum of liabilities and equity, it's 3.4 billion. So you can see that their balance sheet balances. Now, there's just a few interesting items that I want to point out here. And that is, the one is, here we can now see, how did they fund that big loss on the income statement? It's from additional paid in capital. In other words, this is from sales of additional shares. So they've sold a lot of new shares to be able to fund that big expense in the operations. And we can see that the retained earnings, that minus 4 billion coming through here on the equity, it erodes that additional paid in capital, because it erodes the value for the shareholders. And here in the assets, we can see that they still have a healthy cash balance of over 2 billion. That's over $2 billion, and that comes from this additional paid in capital. But if you consider in the previous year, their loss was over 4 billion, then $2 billion won't even be enough to fund one financial year of activity for this company. So clearly, they're either going to have to reduce their expenses by a lot, or they're going to have to raise even more investment. And that might be either through issuing shares or issuing some long-term debt. In other words, borrowing money, because you can see that their long-term liabilities is quite low. So they can still potentially borrow money to fund that big loss. But they must have a strong vision of where they're going in the future, or how they're going to start making money. They might be investing in R&D. They've clearly convinced whoever these investors were, and in fact they listed on the stock exchange. They've clearly convinced a lot of people that they are going to be making a lot of money in the future, and that's why people gave them all these billions to invest in the business. If we move to the cash flow statement, we start with the net income. That is the loss of 3.5 billion. And then we adjust that back for activities that wasn't actually cash outflow. So cash, what was the net effect from the cash from the operating activities, the effect from the cash from investing activities, and the effect of cash from the financing activities. And that gives a small positive change in cash. But that small positive in change in cash is really, for the most part, to do with the issuance of new shares. That's how they're funding the business. One other thing to note is that this non-cash items actually refers to over $2.5 billion of shares or share options that they've issued to their staff members. So even though this company is making a huge loss, and in fact, this is a cause of a big component of that loss, because they have issued share options to their staff members at the same time as they raised a lot of money on the stock exchange. And you see a lot of these American startups doing this. When they ultimately list on the stock exchange, what happens is that the poor people that are buying shares on the open stock exchange are really giving money back to the initial shareholders, to the founders and to the venture capital companies and whoever, the angel investors that invested, because those people sell their shares again after these once it's listed on the stock exchange, and that's how they get their money back, or a lot more. And they sell the shares to other people. That's not what happened here. This was the listing on the stock exchange, but that's the net effect in the end. And they issued themselves a big amount of stock here, or of shares, at the same time as they listed on the stock exchange. So that's actually sort of the founders and the investors, issuing themselves money at the same time as the business is making a big loss. So I'm not sure how ethical that is. I certainly don't think, I think this is borderline or not ethical at all, what they did here. But the point is, I hope talking through this set of financial statements for this public company gives you some idea of the type of, a lot of insights that you can gain from looking at somebody's financial statements. And you can maybe try and practice this yourself by looking at all the public companies on a stock exchange have to issue full financial statements at least every 12 years. Oh, sorry, every 12 months, once a year. And those are open, those are public, that's public information, and you can go and have a look at those and try and make your own interpretation about the financial position and the financial performance of that business and their cash flow health. So the financial performance of that business over the preceding 12 months, that's the income statement. The financial position of the business at the end of the year, which is the balance sheet, and then the cash flow performance over that year. And see if you can gain or glean some of these types of insights that we just spoke about. Okay, so we move on to the next section, which is how to analyze financial statements. And so we've looked at now how to understand financial statements, how to read them. There are methodologies that you can use, some calculations that you can do based on financial statements that will give you even further insights into the health of a business. And they divide it into a few categories. One of them is called vertical analysis. That's really the comparison of different items on the income statement as a percentage of revenue. It's also called proportional or static analysis. Then we have horizontal analysis. That's called trend or dynamic analysis. That looks at changes in the income statement items over time. In other words, how did it change from last year to this year? And trying to look at trends to see how the business is doing over a number of years. And then we have what's called ratio analysis. And that looks at key numbers and ratios across financial statements in 4 different categories called efficiency ratios, solvency ratios, liquidity ratios, and profitability ratios. And you can already see with the title, with the names of those different ratios, what they are about. Now, I don't have time in this masterclass to go into detail about all of these ratios, because within each of these categories, there's probably 10, 15, 20 ratios. In the course, understanding and analyzing or how to understand and analyze financial statements, I do go into more detail about all of these ratios. But for the purpose of this masterclass, we'll just look at 1 or 2 of them. But first, to start off with, to illustrate what we mean with the first one, vertical analysis, and then with the second one, horizontal analysis. Let's look here at this is the actual income statement for Microsoft over 3 financial years. And you have the familiar structure, the revenue, the cost of the revenue gives you gross margin. You have the operating cost, gives you operating income, and then you have the other income and expenses, and that gives you the net income or the net profit. So again, you have that familiar structure. So for vertical analysis, what we do is we calculate everything in the financial year, all the items in the income statement as a percentage of the total revenue. So everything here as a percentage of the total revenue. So the total revenue is 100%, and everything else is a percentage of that. So that's what's called vertical analysis. We calculate every item in the income statement as a percentage of the revenue. And you can immediately see how useful that is, because now we see, well, the products, Microsoft products was in the 2017 financial year, products was 63% of revenue and services was 36% of revenue. So that answers gives a little bit of insight into where does Microsoft's revenue come from products, how much from products, how much from services. If we look at the cost of the revenue, we see how much of the cost was for products, how much for services. We can also see proportionally in terms of operating cost, how much of the revenue is spent on the operating cost. Research and development, they spend about 15% of their income on R&D. They spend about 17% on sales and marketing, and so forth. And you see that their gross margin is over 60%. That's very high for any type of business. That's a very impressive gross margin. Their operating income is over 20%, and even their net income is over 20%. So you remember earlier for Apple as well, their net profit, or their net margin, of course, because we're talking about margin here when we talk about percentages, their net margin was also over 20%. That's a very healthy business. So we can see with vertical analysis, we get an idea of the proportional contribution of different income and expense items on the overall profitability of the business. If we now move on to, that's just a few things that I wanted to point out. So maybe something we can see here is that over the 3-year period, in 2015, the services was only 18% of the business. In 2016, it was 28%. In 2017, it was 36%. So we can see a clear trend for Microsoft of an increase in the revenue from services versus that from products. If we now do horizontal analysis, what we do is we calculate the change in percentage over years. So instead of the vertical analysis where we calculate everything as a percentage of revenue, we now say, what is the change from that to that and that to that? So the change going from 2015 to 2016 and from 2016 to 2017. And now we see that when we look at the products, we see there's a minus 19%, minus 7%. So we're seeing that the revenue from products is shrinking every year, but the revenue from services is growing quite fast, and that more than makes up for the decrease in product revenue. So that overall we have in the last year from 2016 to 2017, there was an increase in total revenue. There was a decrease in product revenue, but a larger increase in service revenue, which meant an overall the revenue grew by 5%. We see that the cost of the products decreased, the services revenue, the cost of the services also increased, so that in total, the cost of revenue increased by 4.5% from 2016 to 2017. However, the revenue grew faster than the cost, and therefore the gross margin also grew from 2016 to 2017. And the same with the operating income, and in fact, the net income grew by over 26%. So all in all, it seems that Microsoft is in a healthy or had a strong financial performance in the past year. You know, the 2017 financial year, and more than that, the financial performance improved versus the previous year. So you can see the value of doing vertical and horizontal analysis if you have information, income statement information available for multiple years for a business. Okay, so I've already spoken about all of those things. So if we move on to ratio analysis, that's the third basic method for analyzing financial statements. I spoke about the efficiency ratios. Those look mostly at the efficiency of operations, mainly things like cash flow management. How is the business managing its inventory, its assets, its debtors, and its creditors? The solvency ratio, that really looks at the ability of the company to meet its long-term liabilities, the long-term debt, and those sorts of things. The liquidity ratios look at the ability of the company to meet its short-term liabilities. Are you gonna run out of cash in the next few months? The profitability ratio looks at the ability of the company to generate a profit, so a return on the assets. So the question is, you know, if you invested in a plant, is that plant sweating? Is that plant running at full capacity? Are you making money on the products that come out of that plant? Also, on the money that the investors gave your company, if it's yourself, you know, or other investors, are they earning a return on that investment? So the efficiency ratios really look at the cash flow statement. The solvency and liquidity ratios look at the balance sheet, and the profitability ratios look at the income statement and the balance sheet. And I'm just going to give you two examples of ratios, because as I said, I don't think we have time to go into a huge number of these. One of the important things when you're managing your working capital, remember earlier when I spoke about the cash flow statement, the importance of managing your cash. Part of your cash is really embedded or caught up in your inventory. If you think about it carefully, let's say that you spend a lot of money on raw materials and you have a big warehouse there, and now you have all this raw materials sitting there. That's really cash that's stuck in those materials, because you can only turn it back into cash when you finally convert that into products and you sell those products to the customer. For the whole time period since when the raw materials enter your factory and the final product exits it, in fact, the final product is sold to the customer and the customer then pays you, for that whole period of time, your cash is stuck in that inventory. And that's why we talk about, you know, that's part of what we talk about in terms of working capital. So if that's the case, you know, if inventory is one of those components of working capital that you need to manage carefully, then you want to be able to have some way of measuring how well you are managing your inventory. You know, how quickly is your inventory moving through your factory and exiting the other side as products, and how quickly are you getting paid? So these are then two of the measures that look at inventory. The one is called inventory turnover. The second one is called inventory days. And inventory turnover really answers the question, how many times a year is the inventory turned over? In other words, how quickly is inventory converted into sales? And we will look at an example just now of calculating. And in fact, it's an exercise that I want you to do. But the way that you calculate it is the cost of goods sold divided by the average inventory over the period that you're looking at. Typically, you're looking at over a financial year. You're looking at the cost of goods sold over the financial year divided by the average inventory level over that financial year. And it will tell you how many times a year does inventory move through your business in and out. And here on the right-hand side, I have the interpretation. So for inventory turnover, a higher turnover is good, a lower turnover is bad. The inverse of the inventory turnover is called inventory days, and that is just calculated by 365, which is the number of days in a year, divided by the inventory turnover, which tells you how long is the company's cash tied up in inventory. And for this metric, you want this to be as small as possible. The inventory days must be as low as possible. So the green arrow indicates that for this metric, you want it lower. When this goes up, it's bad. Yeah, so then we have just an example of one of the solvency ratios is called the debt to equity. That's also called the gearing ratio, and you might have heard of that for businesses. What is the level of gearing of the business? How geared is the business? And that's to do with funding the business via debt versus funding the business via equity. And it's just simply calculated by dividing the total debt by the total equity. So it indicates the proportion of a company's funds that comes from borrowings versus equity. So here it's not so easy to interpret if that goes up or down, whether it's good or bad. It depends on where the company is in terms of that at a specific point in time, and also the type of business that the company is in. Does the company have a lot of certainty about the income going forward or not? Is it annuity revenue business with a low churn, or is it a seasonal business with a lot of up and downs? Is the business vulnerable to economic downturns and all these sorts of things? Because if you have high debt, there's a positive effect for investors in the sense that you're leveraging debt to grow the value of the business. And I'll show you an example calculation that illustrates this point. But the danger there is that if there's a downturn and the company is struggling with cash, it cannot stop repayment of debt. It can stop payment of dividends. So it can control how much it pays out to the shareholders, but it cannot stop paying the debt. So if there's a downturn, the company's in a negative financial position, it might have trouble with repaying the debt, and that could cause the company to go bankrupt. So on the one hand, borrowing funds to fund your business is great for the investors, of which the founders are, all the shareholders, which includes the founders. When things are going well, it's great for the business when things are going well. It's not great for the business when things are not going well. So having high debt levels is risky, but it could turn out well or it could not. So that's just what I'm pointing out there. So what's the point of doing these sorts of analyses? What's a ratio analysis for? It's got a lot of benefits. It allows you to compare your own company against industry benchmarks. Just think about it. If you say, I'm a social media company, you can look at other social media companies and look at their operating expenses and their overheads and their cost of goods sold, the cost of delivering the service as a percentage of their revenue, and see if you are sort of in the same ballpark or if you're doing worse or better than them. It gives you the ability, in other words, to compare your company against other companies and figure out in what aspects are you doing well and in what aspects not. And so that could give you some idea of things that you can focus on in your business to improve profitability. It also allows you to track your company's position and performance over time, as we showed with the horizontal analysis where we compare previous year performance against current year performance. So it gives you some insights into business, the company position. Is the position improving? Is the company performing well? And you can see trends over time, and that can help you manage your own business. So of course, when you have financials for your own business, your accountant might give you or should give you what they call management accounts, which is really monthly financial statements, basically, effectively, because you can't wait for the annual financial statements to manage your own business. You need to look at your business's financials a lot more regularly than once a year, obviously. So at the very least, you probably want monthly management accounts, and that just refers to its interim statement. So it will say performance in the last month, performance in the year to date, and also your financial position at any point in time, so that you can manage your business and pick up on red flags and problems that you need to manage early on. And then, of course, it helps you understand the business better. There's really, the financials, since it's the scorecard of your business's health and performance, it can also give you useful insights into how to improve the operations of your business, how to improve the profitability, and ultimately benefit yourself and the other shareholders in the business. One of the big negatives, though, is, well, it's not that big. I mean, it's not as so big that we should stop doing these sorts of analysis. It's just something to watch out for, and that is that it could incentivize unintended consequences, especially where you have senior, like your CEO and your CFO and those sorts of people being remunerated against incentives, financial incentives. You might say that the CEO doesn't get a lot of money, but will get so many additional shares or a performance bonus based on certain elements of profitability. And if you're not careful in how you set up those incentives, it might backfire, because just like I showed that higher gearing can be beneficial in good, in good times, it can be detrimental in bad times. So you have to be careful of what you try to incentivize. And I want to illustrate this with one example. Our long-suffering national airline, already in the year 2001, by that time they were already in financial trouble, and they appointed an experienced American entrepreneur from the US airline industry to come and turn South African Airways around. But they incentivized, apparently the rumor is that they incentivized this turnaround specialist with a big bonus based on the return on assets. But if you're calculating a return on assets, you can also improve that ratio by firstly improving profitability, but secondly reducing the assets. So that is promptly what this person did. So in fact, I think he only worked for SAA for a year, and he got a big bonus of over $20 million or something for that year, because he improved the return on assets tremendously. But how he did that was he sold all South African Airways planes. So this is a quote from one of the websites that said, or from one of the auditors subsequently, that said the $40 million profit that he claimed evaporated after auditors subtracted earnings from sales of planes and equipment. And actually the airline made a loss in that financial year of $73 million, while Andrews, this person, Coleman Andrews, still collected over $20 million payment for his fantastic performance against his performance criteria. And here we have somebody from SAA at that time saying that it was criminal. Look, Coleman made SAA a world player in many respects. He positioned us to be a player in the global marketplace in the future. But the core business is not any more profitable than when he founded, once you account for the assets he stripped. We wanted an American to show us the ropes, of course, he said, smiling, and he took us for a good ride. So that's just an interesting one, a red flag for, how you set up incentives. That was the little bit that I wanted to cover about how to analyze financial statements. And now I want to give you the opportunity to try an analysis exercise yourself. And I'll open the chat as well to have a look at it. But what I want to ask is that you try and answer this exercise, and the first person to put the correct answer in the chat will get free access to the full course, How to Understand and Analyze Financial Statements. And just to say that the people that won in the first masterclass are not eligible to win again. So we'll hopefully have a new winner. But in the first exercise, what I want to have a look at is the inventory turnover, the metric that we spoke about earlier, and the importance of inventory turnover. And here's some information on your company. So you sold products with a cost of goods sold of $2.5 million over the year, and your average inventory during that year was $2 million. So the two questions are, and so the first one to get both correct will win free access to the course is what was your inventory turnover for the year and what was your inventory days. And there I give you the equation. So this should be a simple exercise for you. So get going. Let's see who's first. Okay, I see Lerato as the first answer there, and I think Lerato, I think you're correct. So excellent, well done on that. So I'll just make a note. We need to contact you afterwards. So I hope a lot of you got it right, got it correct. So it's just simply, you'll just plug in the numbers. The inventory turnover was cost of goods sold divided by the average inventory. So 2.5 million divided by 2 million gives you 1.25 times per year. So this is actually not great for this company. They only turn their inventory around 1.25 times a year. And you can get even stronger idea of how poor that is if you calculate the inventory days, which is 365 divided by the inventory turnover. So if you divide 365 by 1.25, you get 292 days. So that's almost 10 months. So their inventory spent an average time of 10 months in the process, in the system, from buying the raw materials to getting it out the door at the end. So this is not good at all. And I would definitely look at, if I was this company, I would definitely look at trying to improve that. Of course, it's a fine balance. You cannot take inventory days to zero if you're a product company, because one of the worst things that could happen is that you have orders from customers and you cannot deliver. They might not come back the next time and want to buy from you again, or you might lose out to your competitors. It's called a stock out. That's a bad thing to happen for any business, which is you have customers, you have orders, and you cannot deliver because you don't have product. So inventory days, you don't want to manage down to zero. You want to manage it to the minimum level that you can, that is appropriate for your business. Okay. The next exercise I want you to try and do yourself is looking at the gearing ratio. And that really is just, this is too easy to give a prize for, I think. But try and give the answer there in the chat. The question is, so the gearing ratio you just calculate by total debt divided by total equity. So if we have here a company funded with $100 of equity and no debt, please in the chat there tell me what is the gearing ratio for this company. Exactly, Jones is first there. Jones, it's 0. So the gearing ratio for this company is 0. I see 2 other people got it right. Well done to everyone who got it right. The gearing ratio here is 0. If we now say that the company at some point is sold for $130, the return for the shareholders is what it's sold for minus the equity. So 130 minus 100 gives you 30. And they invested 100, so a return of 30 over 100 gives you 30%. If we now say that the same company is funded with $50 of equity and $50 of debt, then what is the gearing ratio in this instance? Yes, that's right. The gearing ratio is 1. So that's 50-50. 50 divided by 50 is 1. And let's say that the company is now sold for the same $130. Remember that they owe $50 in debt. So they sell the company for $130, but they have to repay the $50 debt. So after the $50 debt is deducted from the $130, they have $80 left. They invested $50. So the return for them is again $30, but now the return for the shareholders is $30 divided by $50, which is what they invested. And now you see that the return is 60%. So for the same company that was funded with the same total of $100 and sold for the same amount of money, $130, the return for the shareholders now is double, because they got a return of 30 on their 50 investment instead of 30 on, they only had to invest 50 here. They could have invested another 50 in another company. They earned 30 on that 50. That's a double the return that they earned there. So that is, I wanted to illustrate the power of gearing. So here you see, because they funded some of the operations of the company with debt, the shareholders got a much higher return. So that's why shareholders in some cases might be wanting to fund the business with debt instead of equity. But this can backfire as well, and I want to show you how, or one example of how it can backfire. So in case number 3, again, you can calculate quickly the gearing ratio. Let's see if people can get that right. This company, let's say the company is funded with $25 of equity and $75 of debt. Of course, and again, Lerato is fastest fingers first, it seems. Lerato, well done there. But yeah, of course, a startup company, before you have any revenue, you can't easily fund your business with debt. So typically, this is companies that are already earning some revenue before private equity investors or banks might be willing to lend you any money. They want to see some stability in revenue and or other collateral that you need to have in the business to provide them to be even willing in the first instance to lend you money. But yeah, the gearing ratio in this case is 3. So you can see how the gearing ratio increases at higher debt to equity ratios. This means there's quite a high gearing in this company. They funded a lot with debt and not so much with equity. So let's say that the company lands up in trouble and they can't afford to repay the debt because there's an economic downturn, and they're forced to sell the business in order to be able to pay that debt, that big amount of debt that they have there on their balance sheet. So let's say that they now sell the company for $100. It's not so attractive. It couldn't be sold for $130 because there's the economic downturn. So now they need to repay that $75 in debt. There's only $25 left after they've repaid the debt, but they invested $25. So their return is now 0. They made 0 money. Maybe this is 5 years down the line. They invested that money 5 years ago. They only got their capital back. Maybe they're still happy that they got their capital back, but if you, like most investors, you're not impressed. I mean, they could have put money in the bank account and earned interest on it and would have done better than what they did here. So I hope this gives you a sense of the value of these calculating these financial ratios, the insights that it can give you, and I've also given you a short glimpse of how it can help inform you on how to manage your business. And that's all I wanted to cover on the exercises there. Just lastly to mention, I mentioned it a little bit earlier, everything that we discussed today and a lot more detail, there's a lot of exercises, quizzes, and a lot more training on it as well. All of it is covered in the course Financial Modeling for Entrepreneurs 301, How to Understand and Analyze Financial Statements, which is one of the courses in the Moolman Institute and one of the courses that you can get discount on via TechTribe. And also included in that course, there's some downloadable spreadsheets and templates that you can download that you can use forever. One of them is a spreadsheet where you just enter the financial statement information on a sheet, and then it pops out, calculates a lot of these ratios for you in those different categories. And it also helps you interpret those ratios. It says changes from year to year. It tells you whether that's good for your business or bad. It says, this was for Microsoft, for example. So they remember that their financial statements, they had a very good performance in the year that we looked at. And that's confirmed by the interpretation in this spreadsheet. So this is a useful tool for you to get a sense of the financial health of your business. And that's it. That's all I wanted to say. I think there was another question or two in there. So let me go back. I saw that somebody was kind enough to provide the gross merchandise value So it just says customer to customer exchange site. Okay, it's a measure of the growth of the business. Okay, e-commerce businesses. Okay, so basically it's just the revenue and the calculation of gross merchandise value to calculate gross revenue for marketplaces. Okay, I've got a better idea of the question. I think that's to do with the fact that if you have online marketplaces where you sell other people's products, the gross merchandise value is not your revenue. It's the same with online financial companies. You know, I see a lot of these startups like to report their when you have these financial startups, like let's say e-commerce, or take PayPal for example. PayPal, when you have an e-commerce site, you need to be able to receive payment. So you have these payment gateways, and these payment gateways, you have to pay them money to be able to for them to provide the service on your e-commerce business or your online business, so that customers pay you via them, and they take a percentage of your sales, maybe 2.5%, 3%, 4% of your sales as a cost of as their revenue for facilitating that transaction for you. So for that financial services company, that payment gateway, for example, they will have then the gross sales value, that the amount of money that flows through their gateway, but that's not their revenue. That money that flows through their gateway, all your sales are flowing through their gateway, but their revenue or net sales is only the transaction fee that they take or that they keep back. So that's the relevance of the that's similar to gross merchandise value. It's that sort of gross financial value that they facilitated. When you talk about gross merchandise value online, then you're talking about let's say Amazon Marketplace or Takealot Marketplace, where you are facilitating transactions between third parties, similar to Airbnb or Uber, who takes a percentage, because supposedly, if you remember, Uber likes to tell everybody that they are just a platform that facilitates independent transactions between these independent contractors with the drivers and the people that want the service. And so there will be a certain amount of money that you pay to the driver, but the Uber takes a percentage of that. So the gross merchandise value, or the gross value of the service, would be the total amount of money that you pay to the driver, but the real net sales for Uber would be just the amount that they take. So in terms of how you calculate the net sales from the gross merchandise value, is just, you know, as a platform, what is the percentage or the transaction fee, you know, the service fee that you charge as a percentage of that. And it works the same for Airbnb. Let me see if there's one last question from Jones. What are the key things that I have to look at in monthly management accounts? Is it good to have a part-time CFO? What's the better time to hire a CFO? Really great questions. Thank you, Jones. I think in terms of the key things to look at in the management accounts, you have to look at, really keep an eye on all three of those financial statements, because the one thing, it also depends on what stage of the evolution of a startup you are at. If you're a pre-revenue startup, you obviously can't look at your revenue and your sales and the trend in your sales. But if you are a post-revenue startup, I would certainly keep an eye, obviously, on your monthly sales. You're probably very familiar with that. Hopefully you see an upward growth curve there, and if you're an online business, you might have metrics on how, how you, the point is that you want to try and increase your sales, decrease your costs, or at least manage your costs. Keep an eye on the sales trends and figure out how you can boost your sales. At the same time, you want to look at your balance sheet in terms of how much money do you have left. And if you look at your monthly expenses on your income statement, how long is your money going to last? And as you know, if you're an early stage business, that's a big thing. That's an important thing. And you can't start raising money 2 months before you're going to run out of money, because then you're going to run out of money before you raise the investment, because it takes time. And you need to, and raising investment also takes your eye off the ball in many cases. There's a lot of, I almost want to say wannabe CEOs, but I have to be careful. I mean, it's not always the case, but there's a lot of startup entrepreneurs whose full-time activity is raising investment, and they spend almost no time managing their business. And you must remember that raising investment is not the main goal of your business. The main goal of your business is to develop and place in the market a product or service that is of value to customers and that customers will pay for. Raising investment is a necessary activity in some instances. Raising money is a activity that you have to do in some cases where you cannot afford to self-fund the business, or you don't have any other sources of funding. It's a necessary activity, but it shouldn't become a full-time activity for years. You should rather spend the time on developing a minimum viable product, engaging with customers, maybe get a customer to try to get a customer to pilot and pay in advance for some of it, rather than raising money as a full-time job. But so those are some of the things that you need to look at. And the other thing you need to look at, of course, is your cash flow statement. Because even if you're managing your expenses well, and you're not going to run out of money soon, well, you don't need to raise investment soon. You might have short-term cash flow bites, like crunches, where you get a huge order and you might need to pay for a lot of those things before you can get the cash back, and then you can also get into trouble. There are ways in which to manage cash flow. Well, one of the things you can consider is to try and get customers to pay deposits. That's not always possible, but certainly in some industries it's possible to convince customers to pay you a percentage of the sale up front and another percentage when you finish delivery, and that can have a huge impact on your cash flow. Also, if you can negotiate, if you're a small company, sometimes you can negotiate slightly longer payment terms with larger suppliers. That's not always the case, but maybe 45 days payment instead of 30 days. And those sorts of things can also make a huge difference in your cash flow health. So, and also on that point, if your business gets into trouble, don't be afraid. Don't try and hide away from your suppliers and from people that you have to pay. Pick up the phone, go and see them, negotiate delayed payment terms with them. They are also human beings. They have to manage their businesses the same way, but they would rather, generally, in most instances, they would rather accept a slightly delayed payment from you and be notified that you're going to be late with payment as soon as possible than your company going down and them never receiving any of the money. Because if your company goes down, they might not receive any of the payment. So, don't be afraid to do that, to approach them to talk about that. I think, sorry, that's Tari must guide me here. Is there time to answer one more question?
If it's answered in a minute, if it's possible.
Okay.
And then
you know what, that question, I mean, I just spoke about those indicators already in terms of the indicators of the sustainability. I answered it about when I said what are the things that you need to look at in the management accounts. Already mentioned that the profitability, the expense levels, the fixed expenses versus the how much cash you have, the sort of run rate of the company, how quickly are you burning cash, how much runway do you have left, what are the trends in your sales, when might you need to raise money again, managing your cash flow, managing your inventory, those sorts of things. So I think let me stop there.
Perfect. Thank you so much, Sean. That was great. And thank you so much on behalf of the Tech Tribe community and our audience today for just helping us understand, the accounting part of our business. I know there's a few things I might have missed, and I'm going to make use of that 20% discount that you're offering us for the financial modeling courses. And of course, my colleague will share those details with our audience. So again, thank you so much, Sean, for sharing your knowledge and your expertise with us. We really, really do appreciate it. And I would like to thank everyone that attended this morning. Hope you all have a wonderful, wonderful day. My colleague will be sending through a survey shortly. Please, it's very short. We want to hear your feedback. We want to know what you think, whether or not these masterclasses and these workshops are useful for you, and we can engage more institutions like the Moolman Institute to come and share their expertise and knowledge with us so we can help so they can help us grow our businesses. And upskill ourselves, and we now have a extra tools, financial tools in our arsenal to help us. So thank you once again. Thank you, Sean. Thank you, everybody. And yes, the recording will be shared. The handouts will be shared as well in the coming week. So please look out for an email from my colleague. And on behalf of Sean and myself, Tarisiro, have a lovely, lovely afternoon and a great week further. And we'll see you soon.